All right. Welcome everybody to Minus Investing Live. It's been a while. Been almost a month, at least 3 weeks since I went live. Hope you all didn't miss me too much. I know a lot of you guys are in the Discord, so plenty of you were able to chat with me anyway, but it's definitely been a pretty busy time for me. I've admittedly been focusing on some other stuff in my life other than just the investing world. Dan, good morning. Yeah, I saw your comment there in the Discord last minute. Hopefully, you can at least stick around for a little while. But if you've got other plans later on, no problem. We appreciate you showing up for even a little bit. But yeah, so very excited to talk about a variety of stuff today. It'll be pretty fun, pretty interesting. Uh, as I said, I've been kind of focused on a lot of the things in my life. Definitely trying to put in many more applications. Still focus very much on the post graduation job search, which I definitely think I have some pretty great potential opportunities on the horizon. I'm very excited about. Also been kind of focusing a bit on my health, but not ignoring the markets and definitely trying to get some stuff out there. Which, for the record, if any of you guys out there haven't already seen my mosaic video, I did put out uh, a mosaic materials video not too long ago, only like a week and a half ago or so, which I'm pretty proud of. I did add that company to the portfolio before I even got the video out, but definitely I think an interesting opportunity and definitely one of the companies I'm looking to buy here going forward, assuming it kind of stays in the certain range. I bought a little bit of it and then it kind of went up and then it came back down after I made the video. So now it's kind of back into potential a good buying spot, but it is a commodity company, so I'm trying to go relatively slow with it. Um, Other changes here in the portfolio, we have got rid of a couple minor positions, some of the more macro tool instruments I had. I did have some bond ETF exposure in my portfolio, which I've gotten rid of. I also have changed around the system that I use exactly for determining how much cash I have and how that relates to my S&P 500 ETF position, which I use for my momentum strategy. I've decided to change it so that basically I'm going to make sure that my cash is basically always at or around my target. Perennially last year I had way too much cash, and that definitely caused some significant underperformance for me last year. And so we're kind of looking to change that. So my new system is to basically whenever I'm in a normal bullish momentum phase for my momentum strategy, I will basically have my cash levels at the minimal level of my cash target, which is approximately right here around like 6 to 7%, or possibly even slightly below it. We'll generally basically always try to be below it. And then whenever the momentum strategy switches into neutral mode, we will then sell enough of our momentum position to then put it so that our cash position is up towards the peaks or even a little bit of above it, which you can see right now we are a little bit above it, and that is indeed because the momentum strategy does find us to be in our neutral position currently. So that's the reason why we have the amount of cash we currently do. And then obviously my momentum strategy also has a bearish mode, but that's when I actually short the market. Which is extraordinarily rare. It's usually just 1 or 2 days at a time, and it's usually only like a couple days out of the year that I choose to do that. But the point is, right now we're in neutral mode, so we are a little bit above our cash target, and we're a little bit more above it than I would typically actually like to be. But that's also because on Friday we sold a significant portion of one of our largest holdings, that being Smith and Wesson. Smith and Wesson had their earnings come out on the evening prior, after the close on Thursday. And then Friday, they took off like a rocket, which we'll definitely be talking about Smith & Wesson a little bit. We'll get to them a little bit later. We're going to go through a few companies in my portfolio, the earnings that have reported. As of Smith & Wesson's reporting, my entire portfolio has reported for the earnings season. They were the last one to report in the portfolio. So basically for me, that means my earnings season is now closed. A little bit later than maybe some other people's. Like I said, Smith & Wesson's a little bit of a laggard in its reporting. It's also not its fourth quarter too, so that also kind of makes it interesting for Smith & Wesson. That was actually its third quarter it reported, whereas most companies were reporting their fourth quarter. So a few of them were reporting their first quarter. But yeah, so Very, very interesting. But we're going to be going over a few companies. We're also going to go over a little bit of F&G. They also had reported not too long ago, and obviously they have been one of my largest positions as well, right alongside Smith& Wesson. They were pretty neck and neck in terms of the size before I made the trim. Before I made the trim, Smith& Wesson had become significantly larger than FG, actually. That's part of the reason we were making the trim, is because they were up so much. In fact, if we come down here to total returns for our positions, you can see that Smith & Wesson, we are now up about 50% in total, including dividends, whereas FG were up around 96%, including dividends. And anybody who's been watching and paying attention would know that actually FG at one point was more around 125%, or even, I'm not even sure where it capped out. It might have capped out at like 135% or something like that in terms of the total return that we had. So what that would obviously imply is that FG has come down quite a lot. And quite a lot, enough that, like I said, I want to talk about them a little bit here today, because I think their fourth quarter, I think I can explain potentially why they've come down as much as they have. What is it that the market is being negative on in regards to them? And then I would like to, belie those concerns and continue to bolster the optimism for that company that I've generally had. And in fact, on Friday, with a little bit of the proceeds from Smith & Wesson, I actually bought a tiny bit of FG. A very, very small amount, because they're already well above their minimum position size target that I try to have for them. And they're also my largest position. So wasn't trying to buy a lot of them, but the point is I'm trying to very cautiously buy more, because I still definitely think that they have a large growth track in front of them for the years going forward. So Dan, your comments there. Dan says, about selling positions, I plan to sell one position in the next month as well. Old Republic International, it's an insurance company. They consistently deliver dividends, but I don't see much potential. So I'm moving out of this position into the future ones, and into other ones in future months. Yeah, very, very interesting. Dan has definitely been a pretty fun guy to talk to in the Discord. As of late, he found my channel not too long ago, only about a handful of months ago, and joined the Discord, and has definitely been a very vocal person, always hopping in the chats with me from time to time, which, for the record, we'll just bring that up, here at the start of the show. If you're watching live on the replay, it'd be really appreciated if you could like the stream, help spread the word a little bit by liking the stream. YouTube will push the content more if there's more likes. Also subscribe to the channel if you're not already, and it would be really, really, really appreciated if you could share the content. I have slowed down massively in the amount of content I put out. I'm sure you guys have noticed, both in terms of the videos I've been putting out, as well as the live streams, somewhat for different reasons, but also for somewhat different, similar reasons. As I said, I've kind of been focusing on other stuff in my life. But the point is I've honestly just gotten a little bit tired of the trying to keep a regular pace of the grind at YouTube. It doesn't seem like YouTube really wants to push me that much. So that's where I'm going to be coming to you guys and say, hey, it'd be really appreciated if you know anywhere where people like investing content, please share the stream, please share the content. And then, like I said, beyond that, if you've already liked and shared and subscribed and all those things, there's also the link to the Discord below. Find the link in the Discord, so the pinned comment in the chat. And this is the Discord I'm talking about, where I've been talking to Dan. You can come and join the Discord, be part of the daily discussions that we have here, as well as sharing memes about random things, our portfolios, the actions of major investors, analysis of different companies, academics related to finance, other things like that. All sorts of stuff we talk about here. But there is the voice channels, and I do try to hop in the voice channel at least a few times a week, generally during the weekdays themselves, during kind of the market hours. So if you ever wanted to possibly talk to me about something in the markets, you can come be part of those discussions, as Dan has. So come be part of the discussion there at Discord. Now, also, a couple other things which I've been trying to talk about a little bit more. I also would really, really appreciate it if you find value in this stream. If you think that the work I do is valuable to you in your own portfolio in any way, it would be really appreciated if you could donate to the channel as well. There is the PayPal link in the description below as well. As well as in the last few weeks, I have actually started a Patreon. So you'll find the Patreon link down there below. I started the Patreon because that creates much more easy way for people to give me money on a regular basis at even just a small subscription fee, which relates to the valuation dashboard, which I've put together over the last year, and change, which you see here. So if you want to have access to your own version of this spreadsheet where you can essentially see all the companies that I have analysis for, you can see all of my valuations for them, you can see when they update, and you can compare them to other market and analyst-based valuation metrics, as well as some other factors along the way. You can get access to this dashboard for $5 a month. So go check out the Patreon, $5 a month, and you can have your own version of this file to look at. It has limitations on what you can do with it. It's mostly just for looking. It's not something where you can put any random company in. It's just the companies I've been looking at here, which is mostly the companies I've made videos on, as well as a handful of others. But it also includes the ability to look up the 10 years worth of financials that I've organized for those valuations on one of these side pack pages here, as well as the ability to look up the DCF summaries that I've put together from those as well, including, as you see, the distribution of values that I've created. So if you want the ability to essentially look up my research as it currently is shown at any given point in time, you can do that for $5 a month. So go ahead and join the Patreon if you're interested in that. I'm willing to also take other payment methods. Like I said, you could send me $5 a month via PayPal. That would be more than acceptable for me. But then obviously you would have to kind of keep up with that. So the Patreon is kind of one of the easier ways to go about that. Enough shilling for myself there. We can kind of get back to talking about some of the more core things there. Back to the portfolio. I believe also since our last live show, I trimmed Jackson Financial. I don't believe I had trimmed that prior to the last live show, but that's one company that I did trim from the portfolio recently. They were another annuity company alongside F&G that I had exposure to for a long time. I didn't really build quite as robust of a model for them, really just some kind of simplistic assumptions that I went with. On that one, it was much more of a basic valuation that I had done that was backed up very largely by incredible pricing in the market, super low multiples that I didn't believe that they deserved. So it was a more smaller, short-term kind of speculative pricing-based position, which means that I was kind of prepared to get out of it much faster. It doesn't have the same type of growth profile that F&G did, but we did make some pretty solid gains on that and decided to get out of that position. I did obviously put out my video on Hydrix and Struggles a couple months back. That position has done pretty well as well. We've continued to buy it, and it's already shown itself to be moving a little bit. It had a pretty good earnings season that more than outdid the expectations that I had in that video, which I found to be very bolstering of the thesis that I had put forward in that video. So very excited to continue to buy that one. It is already at my kind of minimal position size, so I'm kind of definitely trying to go slow with it, but I am still trying to kind of nibble at that one a little bit as well. In fact, on Friday, as I said, when I had trimmed Smith & Wesson, I did buy a little bit of a few things. Like I said, I bought a little bit of F&G, I bought a little bit more HSII, I bought a little bit more InMode, as well as a little bit more Silver Corp, which was a miner that I also put a video out not too long ago, which is also pretty much at its minimal size, but you can see that its minimal size is incredibly small. My allocation system says that minimally I should try to get up to about 1%, but I could allow up to almost 8%, including the capital appreciation gains. So it's a little bit of a wider distribution in terms of the minimal target range and the upper target range for that one, especially for such a small position, but interesting. Dan's other comments, I actually don't see your valuations that much, but I really like to look at your list of companies. It's kind of like if Midas is keeping an eye on it, there's probably some potential. I appreciate that. I like to think so, but I certainly get some things wrong here and there as well. He likes when his radar converges his mind. In general, it's a good sign, even though our portfolios are very different. Yeah, as I said, I've definitely talked to Dan a bit, and we've shared our portfolios and our kind of philosophies around investing quite a bit. And yeah, we definitely have very different portfolios, but somewhat similar mindsets in terms of like how to approach value for sure. Mr. Beast, how's it going? Mr. Beast, I'm holding Smith & Wesson. Consider to sell from 10, huge amount. From 10, that's the price you got it at. If so, very nice, my man. Myself, my average cost was actually only about $12 on general. I started buying them when they were at more like $15, and then I bought them all the way down to the like $8 mark or whatever they bottomed out at. I was pretty much buying them all the way down, but my average ended up being at around 12. So I mean, if you're at 10, that means even very nice, man. But yeah, I definitely started to trim already. I sold 1/3 of my position on that one, and it's still oversized by a little bit according to my allocation system. So that means I'll probably continue to trim a little bit, but I didn't want to sell too quickly, but I definitely wanted to sell a nice chunk of it. One, because it was over my allocation. Two, it's definitely not one of the larger growth opportunities in my portfolio. It was definitely more of just like a pure valuation play with what I consider to be a very solid brand in a hated space, in a hated industry that I think definitely doesn't deserve the hate. So that was kind of my thesis behind owning it, but it's definitely not the type of thing that I'm just gonna like let ride at a hold when I'm over allocated. It's one of those things where it's like you definitely got to trim when you get the gains. And also, Smith and Wesson is very known to have exciting earnings reports both directions, and then to drift back the other direction, whichever way the pop was on the earnings. So the fact that it jumped as much as it did on earnings definitely gives me reason to think that it might give back a lot of those gains over the next month or two. Perhaps not. Perhaps not. Because obviously my fair value for Smith and Wesson is actually still higher than where it currently is. It's currently trading 17 and change USD, and my fair value is just below $19. So it is much closer to its fair value when before it was very far from its fair value. So it really just seems to me like the market finally woke up and readjusted to that value. But as I said, it wouldn't surprise me if over the next month or two it still drifted back, maybe even giving back like half of that pop. Maybe even all of the pop. It's hard to say with Smith and Wesson. It really is. It is in fact an election year here in the United States, and traditionally speaking, that is a pretty great year for gun sales. As funny as that is, I know perhaps the non-American viewers of the channel might be like, "Man, what is it with Americans and their guns?" But hey, I don't know what to tell you. Uh, God bless America. That's just how we roll here. In fact, I did a little bit of a funny thing getting ready for the earnings report, because I was optimistic for the earnings report, but as I said, they tend to pop one way or the other, and it had been drifting up before the earnings report anyway, which definitely kind of, if you look at like the previous trends, that would not be a very optimistic sign. It's like usually if it drifts up into the earnings report, the movement is more likely to be down. So it was a little bit of a surprise one to see that we drifted up into the earnings report, and then it still popped and took off like a rocket anyway. But the point is I actually did a little bit of an analysis of the sales of the gun sales in general, not just Smith and Wesson, but gun sales in general across the whole industry relative to election years versus non-election years. And I found that for the last 25 years, if you look at it, the average sales of the 3 years between elections versus the 1 year of the election itself, the 1 year of the election on average is about 22% higher in gun sales. So than the average of the three otherwise. So yeah, it's definitely true that election seasons often mean lots of gun sales. Not because we're necessarily expecting like political violence or anything like that. It's I think often more like people are uncertain what type of rules and regulations might get put in place once the end of the election sequence comes, and so they want to kind of front run the sales just in case there's going to be new restrictions on their favorite products and things like that. So that's just how that works. Dan, did you ever look at Caro? No, I'm not even sure I remember you mentioned that one. It must have passed me by if you had slipped that comment in the Discord. Um, I mean, I have no idea that you guys buy more guns on election year. That's new for me. Yeah, see, that's like I said, welcome to learning about America. Yeah, we take our guns seriously, either for the positive or the negative. Election years are interesting things for companies as well. Tegna, they gain more money on election years like 2022, 2024, and odd finished years, they gain less money. Interesting. I've never really looked too much specifically at that. So anyway, coming down, other comments on a few of the other positions before we move on to some other stuff. I also have been watching F&F, Fidelity National Financial, which has been one of my core holdings for a long time. In fact, they were my number one holding for several years, and they're the company that spun off FG. So the reason that I have discovered and have paid attention to FG is pretty much because F&F acquired them and then spun them off. and they still actually maintain ownership of 85% of the shares of FG, which creates a pretty restricted float, assuming they're going to continue holding that. But anyway, they've been drifting up pretty significantly themselves over the last couple months. My returns on them are pretty outstanding. This total return number right here isn't just the share price, like I said, it includes dividends, but it also includes the distribution of FG that I've received from them. Essentially, my cost basis in FG is a dividend from F&F, effectively speaking, in the way I'm kind of calculating things in here. It doesn't take the appreciation of FG into account. It's just taking the dividend, so to speak, at the time of distribution. That's how I kind of choose to account for these things. But the point is they're at pretty much all-time highs, give or take a few percentage points. Up until just a couple of days ago, they were at those all-time highs. They actually have declined over the last couple of days, ever since the State of the Union address here in the United States, because incidentally, President Biden actually made some comments on title insurance in that union speech. He is apparently looking to lower restrictions in regards to title insurance for federal home loans. Now, the State of the Union address is kind of this thing here in the United States where a lot of politicians essentially put out a whole docket, a whole smorgasbord of kind of like a gimme catch-all, we would like this platform. Just because you say something in the State of the Union doesn't mean that it's actually going to come to fruition. President Biden, for example, has said that they're going to cure cancer at all of his State of the Unions so far in his presidency. Obviously, he's not going to cure cancer. So the point is just because he says something doesn't mean it's actually going to become true, but the market definitely did react to that. But regardless, before he even mentioned those comments, because I'm not actually worried about those comments at all, I'm just trying to explain why it dropped several percentage for the next few days after that. But when it was at its all-time highs, and I still consider it basically close to that, I've definitely been considering doing a potential trim there. I'm not at my peak of my allocation there, but it's definitely not a company where I think of it as having the largest of growth potential. I think it's more of a solid stalwart in my portfolio. It definitely has. It's just going to keep doing its business, and I think it has a great position within its business, which is the title insurance for the mortgage industry. And as I said, they also have 85% ownership of FG. So in effect, they're like more exposure to FG for me. And so, between the two, it's like I would rather have more FG than F&F. So I can trim some F&F as a way of essentially kind of lowering the exposure there in that regards. And they're currently at about my fair value. So that's kind of why I'm bringing it up. I might wait maybe to see if they get a little bit more above the fair value. That's kind of in general where I've been approaching to it. But similar to Smith & Wesson, it's not exactly the largest of growth plays other than their FG segment. And so it's potentially I could choose to trim a little bit of that in order to find funds to put at other places. Mr. Beast, what am I thinking on treasuries? My thoughts are kind of mixed. I don't know if you caught the first few minutes of me talking about the portfolio discussion, but I actually got rid of my exposure to certain treasury ETFs that I had. But that's not necessarily because I was like super, not because I don't think there's potential there. I definitely think if rates come down, that some of the longer dated treasuries could potentially do pretty good over the short to midterm. But I'm not. I kind of switched up my liquidity preferences in terms of like how I want to operate my portfolio, because I had those ETFs essentially as a way of getting excess yield across different parts of my liquidity. I consider it, relatively stable positions. But in terms of like performance, where I think they're going to go over the year or so, I definitely think it's possible that treasuries could do well by year's end. But I also think it's possible that yields are not going to come down really at all this year, potentially. I do think it's possible that yields do come down, and that's what the Fed seems to believe that they're still going to do. And I'd say, as things currently look and stand, we can probably expect some rate cuts probably by the end of the year. Just maybe not as many as a lot of people seem to think under a lot of circumstances. But the point is I would much rather have my money in other places other than treasuries. But definitely paying attention to the treasury market, if not for any other reason, that it's a bellwether for everything else, obviously. One other position I kind of wanted to comment on before we kind of move on to some of the discussions about the earnings reports and stuff. I also have been looking very closely at Meta. Now, I lowered my exposure to Meta pretty quickly last year. They were one of my larger positions at one point when they were kind of bottoming out in terms of their decline. And they've taken off pretty good since then. Unfortunately, I started buying Meta much sooner than a lot of other people, so I only have 200 and change percent returns versus some of the 300 and 400 percent returns that I've seen other people out there with. Definitely jealous. Very, very nice for the people out there. And I trimmed much earlier than I should have, because this is now one of my more smaller positions, and it became a smaller position relatively quickly, even before some of those larger gains. So it definitely could have been operated in terms of that regard a little bit better. But anyway, regardless of that, I've been looking at it and trying to decide at what point maybe I'm just going to trim the whole thing out of the portfolio. It is by far and away the most overvalued thing in my portfolio by my measure. And I think that I have updated it since the most recent earnings report. So this is a fully updated as well. Not all of my companies here have been fully updated with the most recent earnings report. Some of them still need some adjustments in that regard, which we'll actually talk about that in regards to one of them later on. But with Meta, I find them to be at least 30% overvalued, and I think I'm being pretty generous in terms of where a lot of factors are going to go for them and for the valuation. I'm not necessarily giving them some big AI portion of their business, which I'm sure is the way that the market is perceiving them, but that doesn't mean that I have to hold it or believe in that part of the valuation necessarily. So I have been a little bit hesitant to get rid of them in my portfolio, partially because they are essentially my AI exposure, so to speak. But at some point or another, I do think you have to kind of pull the trigger on that. And here they are, over $500 per share at this point. Definitely something to think about. So it's possible that you'll see that one disappear from the portfolio at some point soon. Yeah, look at that Meta performance. All right, so let's move on over to the dashboard. I don't think there's necessarily too many comments I'm going to make on the dashboard other than what I kind of already said, because we already talked about a lot of the companies in my portfolio, other than just to kind of like point out, man, there's that gain from Smith & Wesson there on Friday, as I was talking about, up 29%, which is pretty incredible because it was up like significantly less than that in the after hours. It was up in like the teens percentage, and that, even at that point, I thought that was pretty impressive. And I definitely thought, oh, it could pull back from 14-15% to maybe only like 5% of gains in the next day, but instead it just more than doubled those gains. So pretty impressive. But yeah, we've definitely seen the market be drifting up in general and doing it pretty good. But I would kind of point out that most of the accumulation distribution calculations that I have for all the companies here seem to be showing pretty high levels of distribution. So while decent large segments of the market have been drifting upward, I do think there's actually a decent amount of profit taking underneath the price movements. Hard to say because accumulation distribution is not a hard coded fact. It's just an estimate, so to speak, in terms of trying to determine whether or not buying and selling is actually occurring, but perhaps something to be careful of. We flip over to the market pages that I have here on the dashboard for kind of paying attention to what's going on. We'll definitely comment on a few things in that regard. For one, for example, U.S. yields here. Speaking of treasuries, you can see I have the 2-year, the 10-year, and the 10-year tips as the treasuries that I like to pay attention to for the most part, and they've all been coming down over the 1 week period, the 1 month period, and the 3 month period. All coming down, which have different implications depending on which one we're talking about. The 10-year break-even inflation rate, which is the inflation rate that's implied by the 10-year treasury and the 10-year tips, has actually drifted up a little bit, but not necessarily a ton, up to 2.25 over a 10-year period, compounded. And then you can also see that the US dollar has come down a little bit too. So drop in yields, drop in US dollar in general, that means upward movements for markets. In fact, the drop in US dollar is probably related to the drop in yields because that's definitely a major factor in there. Coming down, we'll skip commodities for a second because we're going to talk about commodities in a moment. Coming down to the actual sectors to take a look at over the last month, which is kind of like since the last time that we've talked, you can see that there's in general been some solid drift up in a lot of the various sectors here. Some of the strongest sectors being in the S&P 500 being utilities as well as materials. Materials definitely being an important one to pay attention to, both in terms of it being a bellwether for future economic growth. Is typically the type of sector that front runs economic growth in general, commodity prices moving. But utilities as well kind of is a pretty solid economic bellwether. Utilities generally only do well if people are expecting there to be relatively solid consumer strength, as well as an increased electricity usage due to economic activity, companies doing stuff, and stuff like that. Coming down to the small caps, materials also being the standout, so definitely an interesting thing to point out there. But energy as well, small cap energy being kind of one of the stronger points on that front. I wouldn't pay too close attention to this column. I actually noticed before I started the stream that there seems to be some sort of issue with the calculations that I have going on with the 3-month column. It only applies to the 3-month column. So these numbers are not necessarily accurate. Some of them might be accurate, but they may not be 100% accurate. So I don't want to necessarily comment on those at this point in time. Coming back up here to the commodities, or actually, well, before that, we'll comment on some of these equity risk metrics that I have right here. I also include the forward PE, which I think is a good, bellwether of general valuation for the S&P 500, but also the implied risk premium, which is essentially the implied excess return over a 10-year period above the 10-year treasury that the market is implying based off of analyst estimates and median case cash payouts. But the implied risk premium, it's been relatively flat. The forward PE has been drifting upward a little bit over the last month or two. So definitely something to maybe pay attention to is that the forward PE is starting to drift upward, but 21 is not necessarily super expensive for the S&P 500 to be at. But the VIX has definitely started to move a little bit in the last couple of months as well. That's definitely kind of the part I really wanted to point out. It's still at a relatively low 14.7. Which is still pretty low, still definitely not super risky, but obviously volatility is starting to move upward, which can be a sign of, that doesn't necessarily mean that things are bad. Obviously, you can have volatility and markets be moving upward as well. You just tend to see much more of it on the downside. So coming back up to the commodities, though, definitely want to comment on that because these are definitely indicators of things that are going on around the economy. Oil is still pretty low compared to some of the points that it had been at its peaks previously. It is up pretty significantly from where it was 3 months ago, but it's been kind of trading a little bit kind of flattish over the last month to week or something like that. I bring up oil in particular because I have noticed that a lot of the oil stocks have been coming down pretty significantly over time, but one particular gas stock, not really an oil stock, it's more just a natural gas stock, which was Baytex, a company that I put a video out some time ago, has actually come down pretty significantly. It's pretty much around its fair value. It looks like my spreadsheet's having difficulty loading all the things. Google's kind of giving out on me a little bit, which it does sometimes. But it's pretty much at its fair value, undervalued by about 8% according to my measure right here, which is not exactly a huge amount, but 17% expected returns with a terminal multiple, which kind of gives you kind of an indicator of how conservative I'm being, of around 11, and it's trading at its 46th percentile. But if we could get that percentile back down into the 30s, maybe I might have to pull a trigger on that one. I definitely kind of almost regretted not pulling the trigger on it before I finished my model, because it was a good value before I finished my model, and then when I put the video out, it had already kind of run past fair value by my estimate, which I mentioned in the video. But I've been keeping my eye on that one. That video did extraordinarily well, and a lot of the comments were very supportive, both of the video, but also very supportive of Baytex. It seemed like there was a lot of bulls that really kind of came out to talk about that one pretty significantly. So I definitely kind of felt a little bit of regret and felt missed out on not having that one. But it's definitely what I consider to be a pretty solid oil and gas play over the next decade, if you can get it at the right price. Now, like I said, I think it's fair value right now. I like to personally look for a margin of safety to make sure that I'm getting solid alpha in the portfolio. So I'm definitely going to still be looking for it to go a little bit lower. If I can get it maybe around that $3 mark, that might be an incredible place to go in. So you could see that one enter the portfolio at some point in the future too. Dan, Midas moving the markets. I mean, I'd like to think that, but of course, I'm just a little small fry YouTuber, so I highly doubt I have too much of an impact, at least on anything that has any significant size. Maybe if we talk about some incredibly small companies, which we'll talk about an incredibly small company here in a little bit. So anyway, with that, that's pretty much all the comments I'm going to make on the dashboard. We can finally move on, and we'll actually talk about some of the earnings reports, as I was saying, and some of my kind of specific comments on them. First, we're going to start with FG. So FG is my number one position now. Has been for some time, but it is definitely now solidly my number one position, with me trimming a significant portion of Smith & Wesson. As I had said, there's obviously been significant declines in the stock over the last few months. In fact, let me show you guys that real quick so you can see kind of what I'm talking about. obviously you can see a very, very small chart because they only started trading at the end of November 2022, which is when they were distributed from Fidelity National Financial. And I was buying them pretty significantly all through the relatively small regional bank crisis that we were having. That's what you see right here was the regional bank crisis. And I was buying. I put out my video somewhere in this range as well. And then it has done incredible since then, which has been a really, really great boom for my portfolio. It seems also like a lot of people seem to have really, really given me a lot of street cred associated with this particular stock. It definitely is like one of the ones that people have essentially been praising my work for in large part. But I'm obviously you can take a pick about just how much of that is luck. Like I said, I never would have discovered this company if Fidelity National Financial, one of my other major companies, had not acquired them and had not distributed them out. And then, well, I had to do the work to choose whether or not to make them my number one position afterwards, of course. So that's where I guess my own choices came into play. But definitely interesting. But anyway, the point is you can see that they topped out around $47, $48 a share, and they've since come back down to around $35, $34 a share. So very, very significant declines. Lots of negative candles right here coming back down approximately to its 200-day moving average almost. Could possibly find a little bit of support there. But as I said, I think there's understandable reasons why they've done as they did. First off, we kind of take a little bit of a top-down view. You can see that their gross sales, which doesn't take into account flow reinsurance levels, has moved up over 17% year over year. The $9 billion for their net sales, which is the actual like reported sales number, which I think is more like up 20 to 25% year over year. In terms of that, assets under management up 14% year over year. Their 3-year average portfolio credit related impairments being 5 basis points, which means like how many of their loans have actually essentially gone bad, only about 5 basis points worth, whereas they're actually crediting for like 5 to 6 or 7 times that, I believe. So very, very good in terms of like the overall credit profile in terms of how they performed during a lot of the crunch of 2022 and 2023. And then they report here their adjusted ROA number, which I don't really necessarily super agree with this number because they're using adjustments that I don't fully agree with. I kind of made my own adjustment figure to try to take back on that. And I personally find a more accurate number to maybe be like 50 to 60 basis points in terms of an adjusted ROA. They're kind of excluding some significant items here. But the point is still relatively good in terms of the low profitability that these types of companies, a lot of financials and especially annuity companies and insurance companies have had over the last year or so, what with mark to market for their portfolios and stuff like that. Anyway, coming down, they I kind of wanted to talk a little bit about some of the growth of their industry. They primarily sell fixed index annuities as well as multi-year guaranteed agreement annuities, which is the kind of part of their fixed deferred annuity category. But they've also done significant growth over the last couple of years in their pension risk transfer segment and their funding agreement segment. These are more institutionally run segments versus some more consumer-facing segments. And what they are is essentially allowing for other companies to offload a lot of their other funding agreements and risk segments related to pensions over to FG, which is more of a specializer in that particular space. So companies that aren't specializing in this type of stuff are not getting the kind of yields that they otherwise would like, which means that they have to put up much larger amounts of capital in order to meet the agreements that they have. They can offload this risk to companies that have a lot more capital than they do, and also give them the ability to specialize more specifically on the actual financial management of those portfolios. They'll talk about here, as I said before, Fidelity National Financial owns about 85% of their company. So it's not only large ownership, but also a controlling share. Come down here and they talk a little bit about the basic details of their book. They talk about, as you can see here, the reserves as it is split between those different segments that they talk about. But here they show their weighted average time remaining in their surrender charge period. So now with the annuities, this is essentially like, you can think of it as like a savings account of a sort for retirees. You're essentially trying to create a term-based life insurance policy, oftentimes for your surviving partner or for retirements or situations like that. And you have, the idea is that you're not supposed to be pulling money out on any regular basis. So you're going to have a surrender charge if you pull money out sooner than the agreement initially said. So the weighted average time in the surrender charge period is 6 years, which means on the weighted average, their money can't be pulled out without a fee for 6 years, and this applies to 92% of their overall book value. Now, they also say that the average remaining surrender charge as a percentage of the account value is 7%. So that means that's the fee that they would get on average between these different categories. Whether or not you're going to start taking losses when people start to pull their money out sooner than you expect essentially comes down to whether or not more than this percentage of the book value gets taken out. If more than 6-7% of the book starts taken out, then your loss charge isn't going to cover your total level. And that doesn't even mean you're technically going to be taking losses. That just means that your book value is starting to suffer much more significantly from those drop downs. They also say how 75% of their book is subject to market value adjustment, which can heavily explain why the gap metrics for the profitability look so bad for the last year and a half, because what with the increase in interest rates, that means drops in market values, which means taking on mark-to-market losses in terms of GAAP earnings. But again, that's GAAP earnings. It doesn't necessarily mean actual cash flows. So that's something that has to be taken into account. Now, these surrender periods is important to talk about, and the reason why we're bringing it up is because this is heavily related to why we're seeing the declines of the stock market for the stock, is because they have had pretty significant increases in the amount of redemptions against those surrender charges. But I'd point out that that means they get to get those 7% in terms of the actual charges that they get. It's actually more profitable for them, essentially, for people to take their money out sooner, as long as it's not so many people coming out of their book value that it actually it affects their book value. So it all comes down to the balance between people redeeming their funds versus people actually putting more funds into the company, which are different customers altogether. They're playing in some pretty high growth markets, which is part of my bullishness related to the stock. Go watch the video I made last year on it. Pretty much everything in that video still applies. If not, it's just really conservative because I've upgraded my valuation for the company significantly since then. But the overall macro and kind of secular thesis I talk about in that video, everything still applies there, which I talk a lot about these high growth opportunities that they're working in. Then here they also show the kind of growth of these different segments over the last several years. Here's where F&F merged with F&G back in 2019, which is essentially when I first became aware of them. And then they also, as I said, got distributed from F&F at the end of 2021. So you can see this is essentially the period that they were being incubated by F&F, and then this is the period when they became a public company. So you can see significant transformation of their business done through F&F, and that's some other things I talk about in that video, is how I think the relationship that they have with F&F is really, really a solid thing that kind of helps them expand their overall customer base, because it gives them access to so many other households. Mr. Beast, still a good price to buy. I assume you're talking about F&G because that's what I'm talking about. As I said earlier, you might have missed that detail as well. I literally bought a small amount of F&G on Friday. They are my number one position, so I don't buy them very quickly because I'm not trying to become over allocated to them. But I do think that they are a value. In fact, if we look at my valuation of them on the dashboard, you can see they're one of the ones closer to the top. I see the 21% increase to fair value, which I haven't upgraded since this fourth quarter earnings report. So it's possible that I'll actually push that value up by a few bucks, maybe even. And 14.5% expected returns over the next 10 years. And that's with a terminal multiple of 7. So it's one of the most conservatively terminally priced companies on this dashboard. In fact, it is in fact the most conservatively priced terminal multiple I'm using on this dashboard. And it's at the 29th percentile of my value distribution. So yeah, I definitely think F&G is a value right now, absolutely. I bought it on Friday. So yeah. But anyway, so the point is, not only does this show the significant growth that they've had over the last few years, which goes in line with my macro and secular thesis, but it also shows the diversification that they've had as well. You can see that they went from primarily being focused on agent-related fixed index annuity sales to a much more dispersed distribution channel, not just agents, but also bank, broker, as well as the different segments themselves, going from fixed index annuities to multi-year agreements, as well as those funding agreements and pension risk transfer. So not only have they diversified across the different segments that they're playing in, but they've diversified across the different distribution channels in which that they operate and do their sales through, which is, I think, very, very good for the overall stability of their business. I think that was pretty much everything in the presentation I was going to go over. Now, there was going to be a few things I wanted to show from their 10K. We come down to what pages down here. Here, the little description of their business. So one thing I was particularly waiting for their 10K, in fact, I mentioned this multiple times throughout the year in the Discord, was that, there's certain details that a lot of companies don't share in their quarterly reports, but they do share in their annual reports. And oftentimes that's like details related to their industry, some details related to their customers, and like more information related to their segments. The type of stuff that's really useful for me when I'm trying to build up a model for the company, because that's often how I like to operate things. Like a pretty simplistic way to think about how to model out revenues for the company. We'll just assume it's like a product number or something. You say, okay, well, how many customers do they have, and what price are they charging on average per customer? And all you need to know is the customer number and the revenue to do the rest, because you can essentially take the revenue and divide it by the customers to figure out a weighted average of what the price per customer you're charging. You could do the same thing with stores. You can say, what's the revenue per stores? You can say, what's the revenue per product segment? All these things, this is the basic fundamentals of how you put together a model. So essentially what I was waiting for all year from FG was an update on this number right here. How many policyholders do they have? It's one thing to see that their assets under management all year round were growing, because they were growing pretty much all year round, but it was hard to say just how much the core business, which is to say how many customers do you actually have, is growing, because this number right here was only shared in their 10K. So here we are, an update. It says that they now have 677,000 policyholders versus what they had last year, which was 623,000 policyholders. So a very significant growth in terms of their overall policy holdings. That's like 7 to 8% or something like that, give or take. I didn't actually do the calculation, but something in that range would be what that is. That's pretty good year over year. 7 to 8% growth in policyholders. As we saw before, it was like 20% growth in their overall sales, which means that they had growth in their policyholders, but also significant growth in terms of the revenue that they generated per person in that overall space as well. So very, very solid. Now, the only other thing I kind of wanted to comment on in particular from the 10K was, so we're going to go down to the actual financial statements, because then I can explain a little bit more in detail about those redemptions and how, like I said, I think that explains why the market is treating it the way it is and why I'm not particularly concerned about it. All right, so here's the statement of operations, assets. We'll take a look at the assets first. So here's their balance sheet. You can see that year over year, they went from almost 55 billion in total assets on their balance sheet to over 70 billion in total assets. So it's very significant growth in the total assets, which is pretty commensurate with their growth in revenues. Being that it's a financial company, the price to book and their book value in general is definitely going to be a much more relevant figure compared to many other industries, because their returns are going to come very specifically from the assets that they have on their balance sheet. 52 billion of those assets are their investment portfolio. So a very, very significant portion of their investment portfolio, which itself also grew about 20% year over year, which is much more even directly related to the revenues itself, but growth in many other assets as well. But coming down, you can see growth in the total liabilities as well, of course, because they take contract holder funds from their customers. They went from almost 41 billion in contractor funds that they had last year to almost 49 billion this year, as well as future policy benefits, which is kind of like another thing very similar. Went from 5 billion to almost 7 billion. So very, very significant growth in that regard. However, their book value in terms of the equity, the actual the equity portion, went from 2.4 billion to 3.1 billion. So still a solid growth in their actual book value itself. And I would point out that the retained earnings did in fact drop. They did take GAAP losses, like I said, due to mark-to-market related stuff primarily. And they also still paid out dividends this year, which also subtracts from the total amount that you would be putting forward in retained earnings. So it's not a surprise to see retained earnings drop, but it honestly dropped by a pretty minuscule amount. And then there was a significant drop in the negative accumulated other comprehensive loss on earnings, which, if you're not familiar with what that is, that's essentially a catch-all grouping on the balance sheet to account for minor little differences in the valuation of various assets on the balance sheet. And so essentially, if there's essentially changes in the value of stuff in their portfolio and in their assets and their liabilities that have changed over the course of the year that don't really have anything to do with the actual operations of the business. They don't really have anything to do with like taking on losses or something like that. Then these figures change. But nonetheless, if you have to redeem on your assets, this can be a relevant factor to just how much book value you can capture. So seeing this come down pretty significantly is pretty great as well. Nonetheless, it doesn't really affect their core operations, but it does still somewhat have an effect on their valuation nonetheless. So anyway, beyond that, let's come down. We'll take a look at the earnings real quick, because I'm not overly concerned with the net loss that you see here. They went from 635 million in net earnings according to GAAP in 2022 to negative 58 million. So that would look like, oh my gosh, they became an unprofitable company. What's going on there? But I would also point out that they have over 400 in depreciation and amortization. This is not a manufacturing company. This is not a product company. This isn't a retailer. The amortization that they have is primarily related to acquisitions that they do of small insurance companies. That's pretty much it, which means it's a pretty irrelevant non-cash charge. It's nothing that's super important to be paid attention to. I think it's something, whereas, for example, changes in policy reserves is also something that can be considered non-cash under certain circumstances, but that's something that is much more real for an actual insurance company. That's something like that's relevant to them making sure they have enough profits on hand to handle losses that they might have in the future. So that's something that like I would never adjust for. And then similarly, we also have market risk benefit gains and losses, which is a relatively small amount. Recognize gains and losses, also a negative amount, not as much as last year. So the point is we can assume that this will reverse itself over time, assuming that they don't have so many surrenders that it overtakes their surrender charge. And we can assume that they might give back a decent portion of this in the future as gains. But the point is we would much rather allow them to make those assessments in the future. But I think a simplistic way of maybe thinking about an actual adjusted earnings for the company in this particular case, it's very contextual, would maybe actually be to just add depreciation and amortization back to this, which would put them at more like 300 and change for the actual adjusted earnings figure, which was pretty close to the adjusted figure that they had actually mentioned. But like I said, I didn't necessarily agree with their methodology for doing it, but this is a slightly different way of handling it. Long way of saying that I'm not super concerned with their earnings in the short run. For me, this is very much more of a growth play. I'm not even really paying much attention to what happens with the bottom line, because I know the bottom line will handle itself over the long run while they continue to grow in the space that they're growing. But anyway, coming down to the cash flow statement, because that's where I think I can make the explanation for why I'm not concerned about their the redemptions. If we look, first of all, their cash flows from operations increased significantly compared to where they were last year. You can see that pretty commensurate with their overall growth of revenues. In fact, more significant than the growth of revenues. And then the investing cash flows is going to be something that honestly isn't super important to pay attention to in the short run, because it's really has to do with when assets roll over and when they buy new assets versus when they redeem other assets. And so you can see, for example, 13.3 billion purchases in investment securities. That's an increase from last year. It's a decrease from the year prior to that. You're going to see them be doing that all the time. And then they're going to be redeeming on other assets as well. And then that's going to be related also to the total net amount between the redemptions and the total deposits being done by their customer on those years. And where we find that information is actually in the financing category. So here, this is where I think it explains the decline in the stock. They went from 3.4 to 3.5 billion in contractor account withdrawals, which is those redemptions, last year, to 4.6 billion. So we had 1.2 billion more people pull their money out of FG this year than we had last year. And the market's probably looking at that and being like, oh my gosh, that's a pretty big increase in redemptions. And then not only that, we have 8.5 billion of contractor account deposits last year, versus the 7.8 billion in contract deposits this year. So not only did we have more redemptions this year, but we also had less deposits this year compared to last year. And so the market's probably looking at the balance between those things and saying, oh my gosh, is their business slowing down so much that people are going to start pulling money out of their accounts, and that's going to be it for them? Now, I don't think that that's necessarily the case. Now, if you, what I would do instead is I would actually look at the net amount on each of them, not at the net amount between, or not the changes on a year-over-year basis between the two categories, but instead more like the net amount. If we net this out here, we end up with 5.1 billion. And if we net this out here, we end up with 3.1 billion. But they're both positive. That's the part I want to point out here. is that they're both positive. The net amount at which they're positive has gone down significantly, but it's still positive 3.1 billion. This company is not in any way in any trouble until that 3.1 billion becomes negative 3.1 billion. You know, that's the point at which you would really have to start be concerned. Or not even 3.1 billion. It would be negative 7% of whatever their book value is. That would be the point where I would say that we would have problems with it. Which, by the way, as I had mentioned earlier, I was invested for a shorter period of time in another annuity company, that being Jackson Financial, primarily on a more more pricing and valuation based kind of approach, rather than seeing them as a growth play. And part of the reason that I don't see them as a growth play is because their dynamics are not like this. Their dynamics show negative net contractor funds moving out over year-over-year basis. And so for them, it's much more of a managed decline scenario, where I thought they were so cheap that I could still make some solid gains on them regardless. Whereas this is still clearly growing. This is something we see as growth. Is the net amount smaller than last year? Yes, but you have to take into account just how much less funds there is available for putting into other things in 2023 versus 2022 relative to the declines of 2021. You have to keep in mind the economic environment we were in 2022, and then also compare that to 2021, because 2021 also was a pretty standout year. That was at the peaks of where the market was. So point is I think this net number will continue to move back up as the interest rates start to go up, or even if they just stay steady. That's the thing, is I don't think they, or not go up, go down. I don't think the interest rates actually have to go down for this number to even go up. I just think that the market has to feel much more confident that we're at least not going to be continuing to go up, which it's possible that it does go up, but I think that still becomes more of a speed bump for FG in the long run relative to the growth profile that they have available for them. All right, so that's all my comments on FG. Long way of saying I'm still bullish on them. They're still my number one position. I literally just bought some more on Friday. So yeah, very, 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 very solid on that front. If we pull open my valuation template for them, come over. I already said how I saw them as about 21% of upside relative to where I currently have things. And then, as I mentioned before, I actually haven't updated this valuation with the most recent quarter, so it's possible that I will even see them as slightly higher than that after I do some minor adjustments on that front. But if you take a look at it, it's like it's not super far from where my my first quartile valuation is, which is traditionally where I think consider something a strong buy. So buying them now, I think, is a pretty reasonable approach. And then on the upper bound of where I think reasonable valuation for them could be is in the 50s, in the mid 50s. They were up at that, as I said before, $47, $48 per share. So they were already above where the fair value I currently have is. But as I said, I think I'm being reasonably conservative in terms of like the growth opportunity that's in front of them. So yes, very, very bullish on FG. Now more bullish since they've come down significantly. I think management, if you listen to their call or read it, you'll find that they're pretty bullish as well on their industry. They don't seem to have any problems with that. In fact, they took a preferred share capital influx from F&F, their parent company, of an amount of a few hundred million. And then they were talking about basically how much ability to increase their overall gross sales relative to their float that gives them relative to other influxes of capital they had previously. A lot of people say like, oh, well, why do they need capital from their parent company? It's like, well, they don't need capital from their parent company, but by taking capital from their parent company, that essentially gives them the ability to roll over more of their assets into higher yield opportunities before interest rates come down, without having to wait for redemptions of other assets in the first place. So it essentially allows them to get ahead of the curve in terms of trying to roll over into higher yield opportunities for them as they see it. So I really do think that FG is definitely one of the best opportunities in the market for a longer term look at like the next 5 to 10 years, and especially in the financial space. Definitely my favorite financial by a long shot. So all right, let's move on to the next one. Let's talk about Advanced Auto Parts next. That's going to be the next one I want to talk about. Now, I put a video on Advanced Auto Parts last year when it was at around kind of similar price to where it currently is now. I can't remember exactly what it was, but I think it was like 69.70 or something like that when I put the video out. I can't remember exactly because I started valuing it after it had made its major drop here on earnings. So I think the video kind of came out somewhere around here, which means as you can kind of take a look at the chart, it had massive declines after my video came out. Which was, a little bit embarrassing. That's always a little embarrassing when something like that happens, especially considering my valuation. I think in the video I had said like 85 to 90 or something was fair value. I can't remember exactly what the number was. I meant to kind of look up the video beforehand, but I have adjusted my valuation many times since then, so that's why I can't remember, because if I look at my spreadsheet, it doesn't show that number anymore. And I will explain. It's like, I definitely believe that I had assumed that they would revert to the mean in terms of their margins much sooner than they really did, or are likely to. And I that have since then moderated that pace in terms of like how long I think it's going to take for them to get back to the steady state margins that I think that they can achieve, which is still kind of in the mid single digits kind of category. But for the next several years, I've essentially given them very low single digits. Like I was projecting for last year that essentially by the year end, I was assuming they were going to have like 0 to 1% margins, and they ended up getting around a 1% margin. So they started to perform much more in line with where my rebased expectations had been. Now, the reason why there's such a large variability in terms of the valuation I was able to get off of that is partially because of they're a low margin business. If you have a low margin business, the difference between 1% margin and 2% margin is only 1% in terms of margin. But in terms of valuation, that could theoretically double your valuation because it's a double of the profits. It's much more different than, say, going from 9% to 10%. And then beyond that, they also are extraordinarily levered. They're a very high leverage business in terms of retail. And I also, part of my belief in them as having a significant opportunity comes from my looking at the ability for them to essentially moderate their balance sheet and to get those things under control, and that creates a high amount of both operating and financial leverage in terms of where their valuation goes. So as they went throughout the year and they weren't paying down their debts and their expenses, that eventually led to much larger declines in the stock price. Now, I'll say I'm feeling pretty optimistic for this next year. They are still pretty much expecting relatively low margins, and my valuation is now more conservative than the expectations that they're putting forward here, because like I said, they achieved about 1% this year, and I think I'm essentially assuming that they're going to move more up to like 2%, whereas they're saying that they're going to do like 3%. So I think my valuation is still potentially pretty conservative. They also have this free cash flow guidance here of minimum 250, which is pretty interesting to say minimum 250. That obviously implies that it could be more than 250. So if your valuation is reasonably conservative on that front as well, then that should give you a pretty solid potential upside in the short run if that cash shows up much sooner. And then another thing to take into account with this, and they talk about this in their call, is that on previous calls, they had talked about how they are looking to sell the Worldpac and Canadian portions of their business. And in the call, they were asked very specifically about whether this free cash flow guidance includes any assumptions about that whatsoever. And they said, no, it does not. All of their guidance assumes everything runs as is, and that all that stuff is available for sale, but no particular sales has been made. So this cash flow is not require them to make a sale of a segment of their business or anything in order to get that, which implies that if they did sell one of those chunks of their business this year as they would like to, then that means that there would be even more cash flow. Obviously, how that affects in terms of actual operating losses on a kind of a GAAP basis will depend on the sale versus the purchase price and all that. So just because they make a sale doesn't mean it's all good, but the cash flow part of it will be at least pretty nice. Now, coming down here to their balance sheet, this gets to one other part that I kind of want to point out, and why I'm especially trying to talk about advanced auto parts here today, is that in this last quarter, they finally did something that I was a little bit more happy with, which is to say that they finally got rid of some of their debt. Now, if you look at this balance sheet right here, it shows the year-over-year change in the balance sheet from 2022 to 2023, which doesn't quite paint the picture exactly that I want, but if nonetheless, if we count up the debt that they had in 2022, they had a little bit less than 200 million on this front, and then they had let's see, 1.2, so we could say 1.3 1.3 billion, and then about 2.3 there, so you could say that's going to be like 3.6 billion in terms of debt, minus like 300 million or so, a little bit less than. So a rough number, we could say it's around 3.3 billion in debt that they had in 2022. Which, as I said, throughout the year, they were not paying down their debts. In fact, they were taking on more leverage in some regards, including even in inventory areas and stuff like that. So that's Part of the reason I think that they continued to decline throughout the year is that they weren't managing their balance sheet super well, and then their margins were also suffering as well. They did go through a management change throughout the year, and so some of those drops in the margins, I think, is somewhat related to that, because they were essentially trying to push out excess costs so that they can give a clean slate for the new CEO moving forward. But nonetheless, that definitely was pressuring their stock pretty significantly. But if you look at the balance sheet now, 500 million in cash is where we're at right here. They don't have short-term debt anymore, but now they just have the long-term debt, about 1.8 billion plus about 2.2 billion. That gets you about 4 billion in total debt. So you can see that their actual debt levels in nominal terms went up year over year, but their net level went down to 4.5. So 3.3 to 4.5, or not 3.3, 3.3 to 3.5 on a year-over-year basis. Their net debt level went up about 200 million. However, like I said, it was larger if we looked at the in-between quarters. We're missing just how big of an improvement this was on a single quarter basis because of the fact that we're looking at just 2022. So if we were instead looking at the last quarter, you would see that actually they have lowered their debt levels by about 500 million just in the last quarter, which is a pretty significant change to their valuation. And I'm actually going to show you exactly how that works. So kind of keep that number in mind. Keep a number in mind that like we're currently at about 3.5 billion in terms of the actual debt level. And then if I scroll down a little bit further, also to their cash flows, you'll see that this is another factor I think that shows why the stock has done a little bit better since this earnings report has come out, is because it also shows that they now have gone from a negative inventory cash flow, meaning they were building up their cash flows last year, or building up their inventories last year, and that made some significant suffering to their cash flows, versus a positive inventory number this year. So they're finally starting to actually clear out on some of those cash flows in the inventories. And this is another thing that if we are looking at on a quarterly basis, you would see that the single jump in this quarter is much more significant than looking at it year for year would kind of imply. Obviously, the total cash flow from operations still has come down very, very significantly, but there was a period there where we were much closer to no operating cash flows. So that's part of where I think the market's improvement, in their opinion, in just the last couple of weeks is largely coming from. Now, like I said, we'll go over to my valuation template for them. Here, growth page, no real need to change much of that. I'm just assuming about 1% growth for the next 2 years before I think the actual thesis for the retail auto space that I talk about in my video will really start to pan out more in a few years or so. But 1% for the next 2 years in terms of revenue growth. But coming over to the margins, you can see essentially what I'm talking about. So now for 2020, I thought I had it at 2% for this year, but apparently I have it up at 3%. So I am actually a little bit more in line with their assumptions for this year in terms of the operating margin. I thought it was a little bit lower than that, but they're saying 3.2 to 3.5% for operating margin for this year. I have 3%, and then I have them going to 4% next year, 5%, 6%, 6%. And then I have them kind of slowly maybe move up to 7% over the next 5 years after that. That's essentially my guide for the operating margins for them. And then coming over to the cash flows, not necessarily paying attention to the actual reinvestment levels, but the point is to show that my expected free cash flows for them this year is 220 million, which is, pretty consistent with that minimum 250 million. So, as long as they're not bullshitting us about this being a minimum, then I would say my valuation is pretty solid in terms of being reasonably conservative for the next year or so in guidance. I definitely think in the long run, their cash flows will start to improve, but they definitely have a few years of pain where things are going to stay very, very muted in the short run. Now, the thing I really kind of wanted to bring up the valuation to show is if we come over to the summary page, take a look at the additives that come onto the enterprise value here at the bottom, where I have the net cash market value. So here, this is the market value of the debt plus the net cash level that I include right here. And this is where it was as of the last quarter, because I haven't actually updated this with the fourth quarter details. So this shows it as of the last quarter, we were at about 4 billion, as I said before. Now, what did I say that their net debt level is at now? 3.5 billion. So that means that there's 500 million in net cash value that's not added onto this valuation. And you can see my current fair value is about $70 per share, which means it's a little bit overvalued. But I do have a place where we can kind of very simply try to adjust that, which is I have a place to include expected value of off balance sheet assets and liabilities. If there's ever things that aren't being essentially included in the operating assets of the company, I can kind of add an extra amount of present value onto the valuation there in certain circumstances. And then it shows up right here as a positive or negative number. I can technically put negative numbers in there as well. But the point is if we just put 500 million in there and come over here, wait for it for a second, give it a moment to work through the 1,000 different scenarios a little bit, and boom, it jumps from $70 per share up to almost $79 per share. As well as going from negative 8% of downside to positive 8% of upside, and the expected returns doesn't really shift too much. But point is I'm trying to show is that, you know, I don't even think it's overvalued now. I think that even just the adjustment in their cash levels gives them that type of valuation increase. So think about what happens if they, for example, were to, you know, pay down another 500 million in their debt over the next quarter, say, net debt. What does that do to the valuation? Well, I mean, you can assume it's probably going to increase it by a somewhat similar level, maybe another $8 to $9. So maybe that pushes it back up to $87. And now we're back up to the valuation that I essentially gave in my original video, approximately speaking. I can't remember exactly what it was, but I think it was like between 85 and 90 or something like that. So boom, just like that, we're starting to push back into the levels that I had essentially promised in the video. It came down very significantly in present value terms, but that largely, in my opinion, while yes, they did underperform in margin assumptions based off of what I said, it also has largely to do with the type of operating and financial leverage that they have as a company, which is both a risk, but also an opportunity. So there you can see, I do think the thesis for Advanced Auto Parts is very much still in play. It was a little bit of a painful wait in terms of the returns. For example, I was down over 25%, around 30%, I think, even at the worst point last year for Advanced Auto Parts, and now we're up about 14%. So definitely almost 15%. Not as good as the downward position, but again, most of these gains came basically just in the last couple weeks. So that's the market, I think, starting to finally really appreciate it. Let's see. There we go. So that's Advanced Auto Parts. Very happy with that earnings report, and I'll be happy to see if the management can continue to perform similarly for the next few quarters going forward. So, all right, so next, let's go over Smith & Wesson. Let's go over some Smith & Wesson. America. All right, so here, the third quarter results. As I said before, this is the third quarter they reported, not their fourth quarter. A little bit of an off the beaten path kind of fiscal year that they use here. Now, the reasons why I think that the market is appreciating them is somewhat similar to the other stuff that we were talking about and for Advanced Auto Parts. But Smith & Wesson, I think in large part it has to do with it being such a small company, and also certain shareholders taking a position. And I think a lot of people kind of sitting on the sidelines because they were worried about some aspects of the finances. And then, like I said, there's also the election year kind of dynamics that people like to pay attention to. So I think there's a lot of reasons why it popped as much as it did. I don't think that, like, even 30% in one day is not something that I would generally expect ever. So it's not like I'm like, oh wow, that just makes super sense that it went up 30% in one day, even though yes, it came very close to my fair value. So while I think it's essentially is like the market just realizing it, but I do also think that it is a lot of people kind of rushing in, kind of last minute after the fact. Maybe they were waiting for a little bit further decline before getting ready to hop back in. But things I kind of particularly want to comment on is the margins, the gross margins in particular. So Q3 gross margins, they had almost 29% for gross margins, and similar number for their non-GAAP margins, but we're going to kind of pay attention to both. So 29% and about 29% in general. And they talk about down here, in the comparable quarter last year, it was actually 32% for gross margins. Now, I actually pulled up, because like I said, with the Advanced Auto Parts stuff that we were looking at a year-over-year number can be misleading. Sometimes it makes more sense to pay attention to what the literal last quarter was, because the literal last quarter is, while it's right, it makes sense to compare the same quarter to the same quarter. The market itself is their sentiment is based off of what happened most recently, right? So the most recent quarter is going to be the sentiment feelings that the market has around the stock. And if you increase compared to the most recent quarter, that's going to give you much more of like, oh, wow, they're actually improving things. So for example, like I said, let's go and take a look at the quarter before that, the second quarter earnings report, and we have gross margins of 25%. 25% and 28% for the non-GAAP margins. So you can see the non-GAAP margins went from 28% to 29%. So that means with the company adjusting their own numbers in their own kind of way, they think that the change wasn't actually that big. But on a gross margin basis, the change went from 25% to 28%. So that's or almost 29%. So a much more significant jump in terms of the gap figure, which could perhaps be pushing a very significant portion of the movement in the stock. It's like that's their core profitability level on a unit basis. So that means that they're going to be able to just generate much more profit per gun. And then also their EBITDA margins, though, you can see doesn't actually necessarily change as much for 15-16% on their EBITDA margin Q2 versus 15.6% in Q3. So no real major change there. It's like 0.1% change. That's not really as impressive in terms of the EBITDA margin, which means that they did have other costs that were essentially getting in line there other than the unit costs. But most people tend to pay and give much more significance to the gross margins in terms of kind of like the long-term profitability of the brand itself. Now, the other thing I kind of wanted to point out is also net income levels as well. We have, for example, the GAAP net income was about 8 million versus 11 million in the similar quarter last year. But if we pay attention to GAAP net income in the previous quarter, it went from 2.5 million up to 8 million. So you can see that that's not quite triple, a 2.5 increase on their GAAP net income, and then non-GAAP income also similarly with the gross margin, not as impressive. The way that they make their non-GAAP income bigger, which is them kind of buffing up their profitability. But if you look at it in terms of like how that adjusts for the quarter-over-quarter changes, that makes it much more stable. It goes from 6.5 million in non-GAAP net income from the previous quarter up to 8.7 million. So still an increase, but maybe a much more moderate increase after they've kind of adjusted some of those funny figures going in there. So a very big increase overall in their profitability. I think that's definitely where a lot of the movement of the stock came from. They talk in their call pretty significantly about how the inventory channels at the retailers have been drained significantly. Something to understand about the gun market is that manufacturers of guns cannot sell their products directly to consumers. They have to sell them to licensed distributors, retailers, as well as law enforcement agencies and stuff like that. So they can't sell their products super directly, which means that they might manage their inventory super well, but if their retail customers are not managing their inventories very well, then that can have a very, very highly cyclical effect on their revenues on a quarter over year basis. And that's part of the reason we see the type of volatility we do in their earnings, not just because the consumer's desire for guns moves up and down at a very volatile rate, but also the management of those inventory channels for the retailers has a massive effect. Actually, we're not going to look at on the call. I pulled open the annual report for looking at the actual balance sheets because it's a little bit larger. Man, I like this new cover for their annual report. America makes me happy to look at that. But anyway, we're gonna jump down to, I think it was like page 60, 90. Was it 90? Might have been 90. But here we go. Going past it a little bit. So jump down to their financial statements. Not too much comments to make about the balance sheet necessarily. In general, I love Smith & Wesson's balance sheet. I think they have a very, very well managed balance sheet. They actually did take on a small amount of debt in this most recent quarter, taking on some notes payable, but considering they had pretty much no debt prior to that, I'm not particularly concerned with that. In fact, that technically would improve their valuation slightly because technically there is such a thing as under-levered for a company. This is because by taking on leverage, you can lower your discount rate as well as lower your tax obligations as well. So it can improve your profitability and it can also improve your valuation metrics due to the way discount rates work. So I haven't done the math on that, but the point is I'm not concerned with them taking on 25 million in debt. It's not a big deal to me in particular. So I'm okay with that. Coming down, we're mostly just going to be paying attention to the cash flow statement. That's really where I think the more interesting details to look at for this is. Similar comments to what I was saying with Advanced Auto Parts. To be honest, which is say that, for example, if we take a look at like the minor things, how things change within this, you can see that they went from 138 million in operating cash flows last year, so a much more significant number, down to only 17 million this year. So huge decline in their operating cash flows, and yet the market is actually treating them relatively kindly in that regard. One thing I would kind of point out is that they did have pretty significant buildup in their inventories in this regard. But what they comment on in their quarter is that this is also something that we're looking at just the whole year, and if you broke it down by quarter over quarter, that they actually had a pretty a much larger buildup of the inventories at the first half of the year versus the second half of the year. So in this second half of the year, they've actually been collecting on that. Actually, wait a minute, let me come back over to the report, because actually now that I think about it, I think they show the quarterly here, so maybe I do want to look at it. Oh, maybe not. Where's the... Oh, my bad. That's right. This is going to be for April 2023. This is from a couple quarters ago. My bad. I don't know why I pulled up in the annual report in the first place. That's my my confusion there. So I guess I do have to look at the run here. Let me try to increase the size of this a little bit so I can look at it. That's right. My bad. Because this it says 2023, but really that's as of the middle of 2023. Because like I said, they have the off-beaten fiscal year for Smith & Wesson. So anyway, here now we have the 9 months ending of January 31st for 2023 versus the 9 months ending for 2024. And here we can see kind of the differences. So they went from having, like I said, the buildup of inventories through the last year through to a positive inventory number this year. A positive inventory number with also a positive accounts payable number. So not only have they been draining some of their own personal inventories finally again, which means that the retailers are finally purchasing from them, which means the retailers have drained out their inventories of Smith & Wesson guns, but they've also been collecting on cash much more significantly from their from those retailers, from their purchasers, relative to what they were doing last year, because this number was basically zero last year, and then this number was negative 560 million. So you can see for the 9 months ending January 31st of 2023, they had negative 21 million in operating cash flows, and they went from that to positive 63 million in the last 9 months. So you can see that, yeah, and especially the last 2 quarters, but this was a pretty solid increase in the most recent quarter as well. And then this is still on the back of them actually having increases in the capital expenditures over that time frame, because they have made the relocation of their headquarters and main facilities to Tennessee, which they feel pretty optimistic on. That was going to make for much larger tax savings for them going forward. And then, as I was pointing out as well, they did actually take out a little bit of debt in the last quarter as well. So overall, the cash flows are looking really good, especially these dynamics in the changes in the working capital. That's the thing that I think the market is especially really looking at, because the fact that this number is now positive means that retailers are really starting to actually buy more inventory from them. And that's going to be good for their profitability moving forward. All right, so that's pretty much all my comments on Smith & Wesson. One more company that we're going to take a look at today, I don't really need to pull up the model for Smith & Wesson. There's nothing super valuable to add necessarily on that detail. So one more company we're going to take a look at today. This one is not one that's in my own portfolio. This is a company, we actually have talked about them a little bit in the past, and at one point on the live show. I don't remember how long ago it was many months ago. And this comes as it was a recommendation from a viewer, one of the members of the Discord, Cliq AG, who really likes to point out really small micro cap companies, especially some micro caps over in Europe, because that's where he's located. But also some American ones as well. But very interested in small caps and micro caps in general. High level compounders, especially compounders with low debt and good management teams and insider ownership, seems to be his particular pick. So he's thrown lots of suggestions my way, and I've definitely said nah to many of the suggestions in the past. In fact, this company I'm going to talk about is one that I had said no to. I had done a little bit of a brief kind of basic valuation work on it in the past, and I said I didn't really like it too much, partially because a lot of the risks associated with the company, but also I didn't think that I saw commensurate upside to kind of adjust for the risks that I saw. Now, I have since been shown otherwise. I do think that it still has a decent amount of risks associated with it. So this isn't something that I'm not going to make a full video for this one. Definitely, because like I think making like an actual valuation video is something where I feel like I'm giving a little bit larger of an endorsement for something. But I might add this to my portfolio. Partially just because I think the risk reward is kind of incredible for this one. So it is risky potentially, but I do think that potentially you get rewarded for taking on that risk. Now, first of all, what is Cliq Digital? Cliq Digital is a German company that bundles different content types, largely bundles content. They sell single content products as well, but for the large part, it's essentially like a streaming service where you can get access to multiple different content types, not just movies and TV shows, but also audiobooks and games and other things like that. So they're essentially trying to bundle up different content types and market them to underserviced segments of the population. Being that they're a German company, they do have pretty significant European exposure. They have actually put their platforms. They have different tags and different brands for their platforms, depending on the countries that they're in. But their flagship product, being Cliq in Germany itself, is also pretty popular in the United States. So they actually have like about a third of their business in well, I'll show that a little bit, but they have about a third of their business in Europe, but they do still also have a pretty significant portion, almost 2/3 of their business in the United States. So while it is a German company, they are actually still pretty heavily marketed towards the American market itself. And I'm actually very curious about this. I wasn't able to find too much information on it. I actually have a poll running on a relatively large poll group on a social media platform that I like to kind of run some market polls on. I'm trying to determine just how many people may have heard of this company, because it definitely is a very, very small company, very, very under the radar. But I do think that they are servicing some interesting segments of the population, perhaps even German speaking population in the United States. That might be a large portion of where their presence essentially becomes. But here, as they talk about movies and series, sports, audiobooks, games, music, as well as a dynamic pricing model for that. You can get it on all the different platforms, obviously, and then you can see here's the kind of the growth story for them. So it's not exactly, in my opinion, the most pretty of industries. Obviously, it's a highly competitive space to be in, the streaming world. However, I think the most competitive part of the streaming world has been everybody's transformation to becoming a creator of content. Right, like Netflix originally was just a producer of content, and then all of the other platforms came out and were also creators of content, and Netflix had kind of front run this by saying we need to make our own content before they cut us off. And so now all of the major streaming platforms are both suppliers of an actual streaming platform, but they're also creators of the content, which kind of creates these like pigeonholed niches of where the content is, and that has driven the profitability of the industry into the ground, as well as I think the quality in some regards too. So I think that by continuing to be just a distribution platform rather than just a creator of content, and then by also bringing up together different types of content into a bundled area, I think that they can create essentially a little niche for themselves where there's going to be underserviced segments of the population, people who don't really want to pay the type of prices that a lot of those other platforms are charging, and they have to charge those prices because they're creating the content. That means that they can offer a lower price and they can sustain themselves at that lower price. So anyway, over the last 5 years, massive growth from almost nothing, 63 million in sales to 326 million in sales. So from a very small company to still a very small company. And you can see they also show their customer acquisition costs, which have grown pretty significantly as well. But the ratio between them is still pretty reasonable. Like it has decreased the overall ratio here, but not at a crazy level. And then their EBITDA has increased pretty significantly as well. Let's see, come down a little bit further. Let's see, where was the next slide? I kind of want to show here. Here they show how they compare to the price point in Germany in particular against all of the other suppliers, with them at $6.99, comparing themselves, for example, to Disney Plus at almost $12, YouTube Premium almost $13, Game Pass almost $15, Spotify almost $18, Netflix almost $18. Apple TV Plus almost $26, Amazon Prime almost $9. In fact, I was almost joking before. It's like in many ways they sound kind of like they're doing somewhat similar to like what Amazon Prime does in some regards, because they themselves offer you multiple different content types, but it's not necessarily bundled together strictly as an entertainment thing. So it's still very, very different in that regard. But it is also potentially a very limited space. for their overall customer base. Here they talk about specifically the German market: 30 million potential customers, 53% not subscribed to any streaming service, 82% do not want to spend more than 15 euros a month on a streaming service. So obviously that would make a cutoff right here. Whereas they could get access to a little bit of Game Pass and a little bit of Disney Plus and a little bit of Netflix and a little bit of Spotify, all for the low cost of $6.99. Right. So I think that's kind of the basis here, is that they're going to be trying to service essentially the people who just don't want to spend a whole bunch of money to get a whole bunch of different content types, and they would much rather get a larger section of different content types for a much smaller price. Like I said, I've been trying to do a little bit of market research, trying to see if I can discover Americans that have actually are actually familiar with this thing, since they do have a significant portion of their sales coming from America. In fact, my theory currently, as I've been looking into this, is that I think that they might be selling to businesses and companies potentially. Like this might be a thing where if you need to be able to play music at your business, but also want to offer some TV services and maybe even offer some recreational areas where there could be some games and stuff, this would be maybe a cheap way for people to get a little bit of everything in that sense. So they can, I can see plenty of small businesses maybe being attracted to essentially this type of thing. But I can see lots of just regular consumers, like I said, plenty of people that don't want to spend more than 15 euros a month, as they say there, but whatever dollar amount you want to say that is. But anyway, their total library of over 2,000 feature films and TV series. 2,000 sounds like a big number, but obviously that's not really a huge number, but that's a decent amount of selection. They say that they have Hollywood blockbusters as well as international majors as well. 100 constantly refreshed, thematically curated music stations, 10 music TV channels, live broadcasts of popular sports, 200,000 premium audiobooks in 10 different languages, 500 cloud-based games, 2,000 browser-based games, 1,400 PC-based games, including AAA classics, as well as some indie, casual, and retro games as well. So they're trying to get themselves into some solid presence across all these content types. Now, like I said, I don't even think this is the most attractive industry to be in. I definitely don't really like the streaming business in general. But I definitely think that the low profitability by being a content creator is one of the most unattractive parts of being in the streaming space. So this does belie some of those concerns, though going towards a smaller niche market creates its own concerns, obviously. So it's not something where I'm like, wow, this is like for sure the next big thing or anything like that. The idea is that this thing is growing, and do we really think that it's just going to essentially stop growing immediately? Or can they possibly sustain even a little bit of growth going forward? Because the truth is all they have to do is basically survive at their current level, and they would be an incredible valuation. Incredible. I mean, incredible. We'll get to some of the details on that here. So coming into their report, they share a few more of the details. Kind of my point is that I actually think that the company, from only having looked at this for a couple of weeks, I think the company itself is incredibly run. It sounds like they have a very good management team. They have a lot of skin in the game. First of all, that's one thing to keep in mind, is that the management team is definitely very involved in the overgrowth. They have a lot of insider ownership. But one thing I really like about them is the way that they present all of their information. They're very forthright with a lot of straightforward information that's useful for building models. They put their KPIs straight up at front, including their paid memberships, which one thing I will point out, this is definitely a concern that I had when I was building my model for the company, is you can see that they actually did not grow their members over the year between 2022 and 2023. They actually had a slight decline in their unique paid members. However, the overall values and of their customer base on multiple different ways of valuing it did actually go up over that year too. So you could argue that they were convincing their existing customers to pay more money, and then that maybe had a small drop in their total customer base. But so that's something that has to be kept in mind. Like I said, I'll show you the valuation I created for them and how that kind of plays out to a lot of these factors. But the point is even if they were just to kind of stay at their current level, they would be a pretty interesting opportunity. But obviously they could also potentially grow significantly. They tripled their unique membership over a 4-year compounded period. Now, another thing, like I said, one thing that shows me and kind of gives me confidence in the management a little bit is just how straightforward they are in terms of their their way of presenting the financial information here. Here in this cash flow section, I really liked. They have their cash flow from operations, which is straightforward, and their cash flow from investing activities. But the thing is that I found fascinating is that here what they show operating free cash flows, which is basically what we normally think of as free cash flows, is operating activity cash flows minus property, plant, and equipment, and acquisitions and other things like that from the investing activities. But they just include the whole investing activities, which I thought was an incredibly high integrity kind of thing to do. A lot of companies, when they're trying to show you what they say their free cash flows is, they often are just including like some of the things from the investing activities, and sometimes it's the correct things, and other times it's missing acquisitions, or sometimes they're not including intangible assets or things like that. The fact that they just were like, nah, we're just gonna give you the whole line, we're just gonna subtract the whole thing, I thought was a really awesome thing. It really shows a lot of integrity, I think, for the management, that they're essentially not trying to bullshit you on the actual flows of capital in the business. And they effectively kind of do the same thing with the financing activities as well. Here showing that now a total cash flow, which we could call on an actual cash flow statement, we would generally refer to this as the change in cash. But total cash flow is a pretty accurate way to think of it. This is also what I would refer to as like equity cash flows. This is cash flows to the equity owner, because you do have to account for the debt as well as the buybacks and the dividends as well in that regard. Now they don't have any debt. They have traditionally been paying a pretty hefty dividend for the last several years, which is where primarily what these financing cash flows come from. And that kind of leads into one of the other things that I think is worth talking about with them, is that because of the fact that they've had a pretty significant decline, let's come over and actually take a quick little look at that relative to their peak levels. They raced up pretty heavily. And then they've been coming down, obviously been trading sideways pretty significantly through here. I think the first time that Crit mentioned it to me was maybe around here or something like that. So I ignored it. I said that I didn't really like it too much, and then it did really well for a little bit. And then now it's come back down pretty significantly as well. And that's part of the reason he was re-mentioning it and we're saying, hey, maybe you should take another look at this. And well, I'm happy I did, because it sounds like it's potentially an interesting opportunity. But the reason why I bring this up is because the management has been recognizing this as well. They have chosen in the most recent quarter to cut, well, not really cut, but essentially not approve their usual annual dividend that they would have been doing for the next year. They said essentially for 2024, we're not going to be doing dividends at all. Instead, we're going to authorize to repurchase about 10% of our market cap. So they did, in my opinion, the correct thing. This is how a company should be managed financially. If you think your shares are undervalued, cut the dividend and do buybacks, because buybacks should be done when you're undervalued. Dividends should be done when you're overvalued, with an adjustment there for tax rates or expected average tax rates of your shareholders or something like that. That would be technically the most efficient way to go about it. And they mentioned this in their call. They say buybacks are more efficient for much of our shareholders, and also we see this as a vote of confidence in our business. And then, like I said, while they make the buyback authorization, they also have insiders making purchases in the company as well. So I think this company has shown, just like I said, just the little bit that I've been looking, it seems to me like this has possibly a pretty stellar management company in terms of like how to actually think about valuation. It seems like they really think about the company from an investor's perspective, which I really like in terms of what they show here. So now come down. That's one thing I want to show in the annual report here, which I kind of already commented on, but I'll try to check this a little bit further up. Combinations. It was a little bit lower. 687. Page 87. 1 second. Come down here to this segment information. Not so much about the actual segments themselves, but the geographic information is what I was kind of trying to point out. I had already kind of said this, but you can see that indeed, like 2/3 of the business comes from North America. Okay, I was actually saying the US market, so it's actually North America. So potentially it's possible that it's a whole lot of Canadians that are very attracted to this product as well. Maybe I'll have to try to look into that a little bit. But about 2/3 of their business, or a little bit less than 2/3 of their business, comes from North America. A little bit less than 1/3 of their business comes from Europe, and then they have a little slice from Latin America and the rest of the world. So initially, one of my like I said, when I first was looking at this, I actually didn't look super closely, and I thought the majority of their business was for Europe. But like I said, finding that it was North America gives me a little bit of larger confidence, just because of honestly the general strength of the economy and the consumer in that space. So definitely something I particularly wanted to comment on. So yeah, very interested in this company. As I said, I think it's a very risky company because of just the nature of the business that it operates in. Is it's a super cutthroat industry, and there's many big players out there that are ready to steal your lunch, and so that's something that you really have to be careful of. It's not so much anything about the operations of the company. Like I said, they don't have any leverage. They have seems to me like a pretty great management team, and it seems to me like they're pretty well run financially speaking. But just the nature of the business they operate in is the type of business where your whole business can disappear overnight if a competitor makes the right choice. So that was definitely one of my initial aversions to looking at this. So I have built up a valuation for the company. I built up actually even a model for the company, and the model is a little bit complex. I'm not really going to go through all the details on it. Good evening, Olga. Nice to see you. I'm not really going to go through all the details on the model, but as I said before, I'm not really going to do a whole video on it, so I want to at least kind of share what I've got a little bit from here. Essentially, the way I look at this is this could go many different ways. How I came up with the growth of the members for the company is definitely the weakest part of this model. The actual like projections of like where the revenues would go is the weakest part of this model. So it's definitely something where I don't have a whole lot of confidence in where I think the revenues are going to go. They did manage to triple their unique members over the last 4-year compounding period. But in my opinion, that entire business could basically disappear pretty quickly. So thinking about where the company's going to be 10 years from now, which is how I build my models, is really hard for me to do. So what I chose to do is I chose to be extremely conservative in my bear case assumptions, but also try to give them a pretty solid potential for their bull case scenarios. So in the bull case scenario, I'm assuming that they more than double, less than triple their total unique paid membership over the next 10 years, up to 3.2 million from 1.2 million. So an increase of about 2 million or so, which is a pretty big increase, but that's not a very large absolute number. As we saw before, they shared that their total market size in Germany was much larger than that. It was like, what was it, 30, 40 million or something like that? They were saying that there was a pretty large potential market there. And that's just Germany, obviously, there's the United States and Canada as well. But in the bear case, I'm essentially assuming their whole business gets eaten. The whole business basically gets destroyed in my bear case scenario, which is not something I normally typically like to do. Oh, hey, well, actually, there's a useful take right there. Olga, I am from Germany. I stay away from Cliq, but you're aware of Cliq, at least. That's kind of interesting to say about it. If you wouldn't mind, I would definitely be curious to hear some of your thoughts. Why do you stay away from it? Is it because they seem like they just don't offer you things that are interesting, or is it because like of an actual like bad experience with them? I would definitely be very curious to hear your thoughts on that. That would be very appreciated. And practically, like, do you know other people that use it as well? Is it just you that doesn't like it, and maybe do you know people that do like Cliq and use Cliq? Do you know businesses that use Cliq? I would definitely be very appreciative for some answers on that regard. It's being pumped on German financial boards, news, Telegram channels, etc. So very large marketing campaign. Is that what you're talking about? The company themselves definitely talks about their marketing campaign. They definitely seem to be putting a lot of effort into trying to market themselves very hard. So that's not too surprising to hear that you're seeing a lot of that, because yeah, like I said, I've been trying to do a little bit of research here in America on that regard, and I haven't really found very many people that know about it. But as I was also just talking about a few moments ago, it's possible that it's more of a Canadian thing, because the two like 60% plus of their business comes from North America. So while it is a German company, so it's one of these things where like I'm trying to discover like where that business in North America actually is, since it is the lion's share of their business. But I'd be very curious on that. I personally don't know any products they offer, but could be bigger internationally. Yeah. Okay. Do you know any people in your life that do subscribe to Cliq? That would be like the one other question I would definitely really like an answer to. Because like I said, it's like they have a very small customer base. First of all, it's like 1.2 million is pretty small. So it's like it's possible that they're just super under the radar. but somebody's paying for them. Somebody's paying for them. It's not like you can't AstroTurf 1.2 million members that easily. It's not a very simple thing to just kind of fake. So it's like, it's possible that they're just so niche that it's hard to find where those people are, but I'm definitely looking for it. No? Okay. Interesting. Well, that's definitely something to take into account. But anyway, so like I said here, I'm looking at the model details. In my worst case scenario, I'm basically trying to destroy the company. That's basically what I'm doing here. Is I'm trying to say is like, okay, well, let's see what happens if the company basically collapses over a 10-year period. And then over a bull case scenario, I'm assuming maybe that they do have less growth than they had over the last 4 to 5 years, but definitely a significant amount of growth. And then my base case is kind of, typically middle of there. The base case assumption, I assume that they make it up to 1.7 million versus the 1.2 million they have right here. So I think that's definitely a much more moderate a set of growth to have over, again, a full 10 years. The only other details, like I said, I want to comment on is like where that actually means for the overall bundled content. The bundled content segment for them was 300 million, which out of 326 million for their total revenues. And then basically in the base case, that makes them go to possibly up to like 700, 800 and change of total millions of revenue. So I'm still essentially saying that they could potentially triple their revenues even if they only increase their subscriber base by less than 50%. And that would come from basically offering more services to them. As we said before, the total dollar amount that they're actually charging is a relatively small amount. But in our worst case scenario, we assume the revenue drops to less than 100 million. But I could also see them possibly going to billions as well. So that's the thing, is it gets very complicated when you look at the model. The operating incomes and the cash flow numbers I have go incredibly negative. So we have them lose money into perpetuity in our base case scenario. And then, as I said, if we come over to the actual valuation and how that plays out for everything in here, they also have in general had mid-teen operating margins, historically speaking, but even in the cases where I think that they survive, I have them going down to more middling levels of margins here, which it might seem strange to see. Like for the bull case, I actually have them at 2% margins. So because I actually think that they would, for them to generate that type of revenue growth that I show in the bull case scenario, they essentially would have to do so much marketing that it would essentially bring down their margins down to almost nothing. But that still creates a pretty interesting opportunity for them just because of the massive growth in the revenue. Whereas if they stay at more of a middling level of growth, I actually think that they can sustain much higher margins still in kind of like the upper single digits versus the mid-teens, which is where they currently are at. They're currently at like 14 to 15% in terms of margins. So like, I'm definitely moderating my margins even on the assumptions where that they succeed in their growth prospects. But in my bear case scenario, I assume they lose into perpetuity. You can see here, they start losing at year 6 significantly, and it only gets worse and worse and worse, down to negative 46% operating margins, which is, obviously complete destruction of their overall value. So you can see that the median case outcome allows for them to still have like 17 million in operating income for the 10-year forward period, but the actual average ends up being negative just because of the outliers there. JPM UK reports a lot of short positions. Yeah, I mean they do have some short positions out there, but I honestly like short positions to a certain extent, depending on what I think about the company itself. And I don't know at what point you entered the stream, but I was also talking about they also have a pretty significant buyback authorization that they recently announced. So being a short seller might be a risky move on this particular company, considering they have no debt and a large buyback authorization. Definitely potentially a risky move there. But anyway, so coming through to some of the other assumptions, capital expenditures, I also generally assume that they kind of like maintain similar levels of capital expenditure movements over time, except for in the bear case scenario, we assume things get much more expensive for them in capital expenditure terms going forward in general. And then on the discount rates, we use kind of much more traditional assumptions for my valuation there. It's a website for earnings on German capital company. Interesting. I'd be curious. We can't really share that here. I don't know if you're in the Discord, but if you're in the Discord and you could send me some links on that, that would be interesting. You can't really put links in the chat, but it would be interesting. Anyway, so coming over to this, now we'll say because of the fact that I'm using negative operating margins to a significant degree in the terminal years here, it basically destroys the average outcome that we end up with, the expected outcome that we end up with. It kind of like skews everything so dramatically. So when we look at the distribution here, you can see that the expected value actually shows up as a negative, and it can't calculate the expected returns as a result. So you can basically ignore this. And the reason why is because the way it compiles the expected value is it takes all 1,000 of the valuations that I create, including the negative ones, and then it essentially adds them together at the weighted probabilities that they're included at. So it doesn't really do a correct calculation there. So for this particular company, since I'm using negative perpetual operating margins in 20% of the outcomes here, it's going to create a massive skew there. We can see, for example, that about 20% or a little bit less than 20% of the outcomes, the value is essentially zero. So ignoring the expected value line, we're just going to focus in on the interquartile range as well as the actual value distribution here. And again, keep in mind, I think this is an incredibly conservative way to think about this company. It's like we're basically trying to think of the real worst case scenarios here. The real worst case scenario is that their entire lunch gets eaten and their whole business gets wiped off the map in like 5 years' time. And so that's what I've kind of tried to include as best as I can here by having, like I said, 20% of outcomes where they literally just can't even make an operating profit. And then that transforms to a little bit over 20% of the valuations where they're worth between $0 and $3 per share. And this is in USD for the record once it makes these final conversions. All the other numbers were done in euros and stuff like that. But by the time we make it to this page right here, everything is in USD. So the first quartile range, though, for the actual quartile range, I think this is a reasonably reliable risk-adjusted way to look at the company. Under some circumstances where they manage to survive, but for many years, but even potentially not all 10 years, because that's what is implied by a 10-year cash flow being negative right here. That implies that they may only survive 8 or 9 years, or maybe they even survive 5 or 6 years, but potentially they make so much cash flows in those first few years and hand them out to the shareholders that you can actually make a good return anyway. So this is incredibly speculative. This is definitely an incredibly speculative valuation to be looking at, but look at the potential. That's the other thing I definitely want to point out, is that even with these incredibly conservative, potentially ruinous assumptions that I put here, the first quartile range is at $11, which is 40% away, but I would say only 40% away, like relative to the potential risks here. Only 40% of downside, where you could then add into your position, assuming everything's going well, is not actually that crazy comparative to being an almost double on the median case and an almost triple on the upper quartile range. And this is, of course, also just a fair value. This is just a fair value, not the future value. So any future value would have to be taken into account with the discount rate. This number would become more like $50 to $60 10 years from now. This number would become more like $100 10 years from now as well. So it's one of these things where, I think it's very interesting. They're planning to do a capital raise and seek approval at the AGM. That's interesting. I definitely have not heard about that, and that would definitely change some of my perspective on it. If you could show me, if you could send me something in the Discord about that too, that would be appreciated. Maybe I'll have to look into it, because, like I said, the most recent thing that I saw was about their buyback authorization, which is kind of the opposite of that. When they say capital raise, is that maybe for debt then, or are you saying equity raise? Because technically that would be kind of counterintuitive if they announce a buyback but are also planning to do a massive capital raise. That's the thing, is like, are we talking about like a nominal capital raise or something that's actually substantial? Because I don't know, like I said, it's like your new shares, interesting. Well, that could definitely change things up very significantly for my perspective here, because like I said, they said only a month ago that they were doing a buyback. So that sounds like not really what I've seen. So I'd be very curious about that. I'll have to look into that. Like I said, I haven't taken a position on this because of how speculative it is, but it's something where I've been looking at this and just saying, like, this is kind of insane. Is there something big that I'm missing? But if they're going to massively dilute the company, that could definitely make an effect that could be bad for it too. It also could be that they have significant plans for that capital raise too. So no, not all capital raises are bad. That's one thing to keep in mind. Just because you're diluting a company doesn't mean it's bad if you use the money for something that actually grows the company. So I'll say that isn't necessarily negative, but it does sound counter to basically everything else that I had already read. Now, what I did is I also created a secondary template filled out for them where I take out a lot of these crazier assumptions about growth and decline. And instead, I just say, well, what if they could maintain their current level? What if they instead just just managed to maintain their current level. So I have zero revenue growth across all outcomes for the next 5 years. And then it does actually start to have revenue decline for the 5 years after that, but that's partially because my terminal growth rates are negative because of the multiple that I'm assigning to the company. It's worth noting that like the multiple I'm assigning is a weighted average of 6 to 7. This is the distribution. So we see some outcomes where they go to a 9, which is kind of around where they traded in the past, but we actually see significant outcomes where they stay much lower in terms of the multiple that they trade at. And so with that, that means very, very low negative terminal growth associated with the discount rate that I had in order to get that expected terminal multiple. So I keep that same terminal multiple and discount rate assumptions in this steady state version of the valuation. So that means for the next 5 years, it actually does have declines, but not necessarily a crazy amount. They lose about a third of their revenue in the bear case. More like middling levels, a 2%, negative 2% COGR for the base case, and then they stay at 0 for the bull case. Then for margins, I assume that they keep the same margins that they've had for the first 5 years, and then they go towards my terminal marginal assumptions for the next 5 years thereafter. And then in the capital assumptions, I keep it basically the same as the other one as well. And so with this, which is more like a can they at least just maintain their current level type valuation, this is what we end up with as the valuation assumptions. We end up with an interquartile range of 25 to 37. So you see the third quartile is much lower than it was in the other one, which was like at 56. But the first quartile, it's actually now under the first quartile under these set of assumptions. So if you can assume that growth is dead for the company, but they're not gonna die, at least. Like they're at least gonna maintain their current level for the next 10 years, then this is the type of valuation you actually end up with. So very, very interesting. Yeah, I see the a notification. So yeah, cool. I will definitely check that out after the close of it. But yeah, so like I said, I'll definitely have to look into the AGM, and look into the capital raise. I'd be very curious about that. Um, because I don't know. It's like not gonna lie, that sounds strange compared to just all the other things that I had read. It's like I wonder why I wasn't seeing that on their site. If like why it's like I didn't even see. Well, I don't really don't necessarily look into it too much right now. We're kind of already at the cap of when I want to look into it. But like I said, I part of the reason I'm talking about this is because I'm looking for something to show me where I'm wrong. That's something what we're looking for here is trying to understand like what's the situation. Why is this opportunity so good? That's the thing you always have to ask when you find something like this is where am I wrong? If you find something where you think you see a potential five bagger, which is essentially what I'm seeing here, is I see something that has potential like five bagger potential, then I'm wondering where I'm wrong. You should always assume that the market is right and you're wrong, unless you have very, very solid convictions as to why otherwise. So that's definitely one of the things where part of the reason why I like to talk about these things is like I haven't jumped into this yet because I wanted to kind of get some feelers out there, but it'd be very interesting. Yeah, Dan, I would be surprised if you have it available because I barely have it available to me. I do have an interactive brokers account. And interactive brokers have the AGM over here. Interactive brokers will allow me to pick them up, but for a €3 fee. So I'd be AGM. I'll have to look after the stream to be honest, but check news. The German site. Well, I can't read German, so that's not going to be. It's not going to be very. That's fine. I'll have to like use a translator thing on my browser maybe. We can get it to, there we go. Okay, cool. I got my app thing to work. This is supposedly the AGM thing. Yeah, German words are usually like compound words. Their language is very heavily built around like large compound words. It's definitely just something to understand about it. Wonder if I can, is this thing gonna work for the PDF? I might have to use a different thing to get it to translate the PDF. I'll definitely have to probably look into it later. It's probably not something I can do super easily right now, considering it's going to be in German. It's like I myself do not speak German, but I'll definitely have to look into that. That's very interesting. It's very interesting that would be what's going on there, because that would change a lot of my perspective on the company potentially. Like I said, I'm very curious what the situation is with that. But yeah, I'll try to look into it later, but it's going to be a little bit hard for me to go through it, since I'll have to be doing some translation there to get it to work. But hey, I super appreciate you showing up though. It's really great that you showed up when you did, considering I was making through all this, and essentially I was just like looking at this, and I was like really wondering whether or not I should be taking a position like Monday. You know, I was really trying to be like, man, I feel like I need to jump into this. It was going to be a pretty small position one way or the other, because like I said, I see some super huge risks even just with the business. Just with the business, it's something where I'm like, I don't really want to take a high risk on it. But if it's potentially, like I said, a large multi-bagger, that's something that you can't sneeze at too. It's like the potential, the under 20% of conditions to potentially lose, because that's what I'm essentially implying. I'm essentially implying like a 20% chance of 100% loss. But the potential to make 5-bagger more than covers that potential loss, right? So it's like that's a risk reward that is appropriate for the amount of risk. So that's why it's like, but my skew there could be wrong. You know, it's possible that it's much more than a 20% chance if they're going to dilute shareholders and it's not going to anything useful. But that's the thing I would wonder about. It's like, what would they need the capital for, considering their financials are in a great spot. Like their financials are in a great spot. So that's where I would say it's like they might be doing a capital raise, but that might not necessarily be bad. Like maybe, do they have like a big acquisition in mind maybe or something? You know, it's like just because you're doing a capital raise isn't necessarily bad. Just because you're diluting doesn't necessarily mean it's bad. It's strange that they would be talking about doing buybacks while they're doing a capital raise, and that definitely raises some serious question marks for me, because that sounds kind of shady a little bit, right? But it may not be. It may not be. Not if you're trying to do an acquisition with your capital raise, and then you're preparing a buyback authorization so you can start to repurchase those shares afterwards. That's not necessarily bad at all. That actually might be just perfectly good management. So it kind of depends. I'll have to look into it. But I super appreciate you bringing that to my attention. Definitely. Very interesting. But either way, it's still a very interesting company to look at. Definitely something I'm gonna have to look a little bit further. Maybe can't hop into it super quickly. Might have to take a little bit longer, maybe another week or two of really looking into it. But it's something I was very curious about, and I'll have to bring it up to Cliq because I don't think he was here today to look at. So 280,000 new shares at €1. How can that be? At €1, they're not even trading at €1. I'm not gonna lie, a part of me thinks you might be misunderstanding something too. Like not to super strong, but like part of it sounds like that they can't, like it sounds very weird. That doesn't really sound like that makes a lot of sense. I don't know. Like, is it an authorization for something rather than an actual raise? Like that's another thing I would wonder too. It's like, are you like for sure that this is something that they're looking to like for really do? Like I said, I'll look into it. It's going to be hard for me to get through the document because it's in German, but I'll have to look into it, and we'll maybe bring it up at our next live, depending on what answers I find. But it just sounds very strange, very strange. I don't know why somebody would do that when they have an actual, like they have, because like why would you raise capital at €1 when you're trading at like 18 to 19 euros? And the shareholder, and like I said, the insiders are also in there, so it's like I don't know, it sounds very strange, but I'll have to look into it. But anyway, that was the last company that I wanted to take a look at today. Like I said, I saved it for last because it was one that I don't already own, and also two, a very, very strange one that required a lot of thinking, looking through. But so that's pretty much it for the companies we look at. I'll say, be on the lookout this week. We're getting U.S. consumer inflation expectations, which is something pretty core that I like to look at, as well as the actual reporting of the CPI as well is coming out on Friday. Is it? Yeah, Friday. Maybe it was Thursday or Wednesday. But we're getting inflation data this week as well. So keep an eye out on that. It'll be very, very interesting to see if that's another hot number relative to that. Capital Rohang. Okay. I don't know how to pronounce these words. I'll look into it. Like I said, I think I know of a tool for translating PDFs, so I'm probably just going to do that. But it wasn't a browser application that I had for the website, at least. So I think I can just translate the whole document and then I'll just read it. But it's something I'll have to do after the fact. And like I said, like I said, just because I have a big question mark doesn't mean like I'm saying like, not to try to say like I'm not saying I think you're necessarily wrong or something. I just think it just sounds strange. And I wonder if there's maybe a misunderstanding there or something, because that seems weird, especially if you're saying at €1. See, it's like one thing to say that they're issuing new capital somewhere around their current share price, because I wouldn't necessarily be bothered by that. But if they're going to issue a whole bunch of new shares at €1, that makes it sound like there's something strange there. So I don't know. Like I said, I'll have to look into it, but very strange. But anyway, so that is going to do it for today, though. I appreciate you guys coming out. I know it had been several weeks since we had done a live, so I kind of appreciate how many of you guys were showing up. We had a nice little vibrant chat there, and we got through a lot of interesting stuff today. I'm not going to be promising a live show a week from now because, like I said, I've been trying to focus on some other things in my life, school, career, health, a lot of those other things. But maybe next week we'll have another live show. Maybe the week after that, it'll be something like that, and maybe I'll have some new thoughts around Cliq Digital one way or the other. So I'll catch you all in the next live stream. Keep an eye out for maybe the next valuation video. And as I said at the start of the stream, if you haven't already liked the stream, it would be super appreciated if you could like the stream. Subscribe to the channel if you're not already. If you're potentially find value in the things I do, there is both PayPal links and Patreon links below that you could donate to the channel. It'd be really appreciated. The Patreon also allows for a $5 a month subscription to the valuation dashboard, so you can get access to the monitoring of markets and macro indicators that I have up here, as well as being able to look at all the valuations I do, including financials, as well as the DCFs and the templates for the base valuations for full models that I've done. So I'll catch you all in the next live stream. Thanks for showing up here today, guys. Bye.